Hello, everyone. Good morning, good afternoon, good evening, and good day to you. Anywhere you may be joining us all over the world, from Asia to Africa to America to North, South, Central America, Europe, the Middle East, or any continent of the world. We appreciate you. Thank you for always connecting with us on this YouTube channel. Please subscribe to this YouTube channel, like all our videos, and share to business owners, entrepreneurs, and professionals around you. You know that this platform is, dedicated to business entrepreneurs and professionals all over the world, from Nigeria, Ghana to Kenya to any countries in Africa, in Europe, or any continent of the world. So feel free to reach out to us on all our professional consulting service. We are your strategic business growth support partner. So today's video is a very important video building up on Nigerian Tax Reform Act 2025. We have a lot of videos on our YouTube channel, and we encourage you to watch all these videos because they are practical, live session videos to equip you, enlightened, well informed. You'll be prepared before any risks will happen, any risks of non-compliance, any risks of not, doing the right thing in your business will happen. So do well to watch all these videos, and of course share it with all business owners. So regardless of our busy schedules on a daily basis, we have taken it upon ourselves, right, to always be showing on this channel. So connect with us, subscribe, turn on your notification button, and let's make sure that the right thing are being done, the right compliances are put in place for the business in this year 2026. So today's video is very important videos and is a must watch. Allowable and disallowable expenses under the Nigerian Tax Reform Act 2025. Allowable, what is allowed, what is taken. Disallowable, what is not allowed, what is rejected for expenses that you may be incurring in your business to reduce your tax liability. So which one are allowed, which one are not allowed? So you need to be aware of all this so that as you are incurring those expenses, you will know that incur these also expenses, it will be allowed for tax purpose. For tax purpose. Remember, thank you for joining us, Ngige. Thank you for joining us. Please subscribe to our YouTube channel. So, allowable and disallowable expenses. When you are running a business, there's what we call expenses. You will incur expenses, and those expenses are to reduce your tax liability. So, that's what we'll be showing you on the live streaming. Please subscribe to our YouTube channel, like this video, and share it with business owners, entrepreneurs all around you. So, hello everyone, welcome to TOSJOHN Consulting. This is YouTube live streaming. If you are a business owner, of course, you are a finance manager, you are an accountant, you are an entrepreneur in Nigeria or any part of the world, this session could save you millions of naira in tax exposure. This live streaming session is a practical one, and it could save you millions in tax exposure. So in today we'll be discussing a very important video, allowable and disallowable expenses under the Nigerian Tax Reform Act 2025. So you will do well to stay through with us on this live streaming because it is very important. So many businesses are still calculating tax using outdated rules under the old Company Income Tax Act. Don't calculate your tax under the old tax. There's a new sheriff in town. There's a new law that have been enacted and is in force already. So the better you understand this Nigerian Tax Reform Act, right, the better it will be positioned, you'll be positioned for your business. So please get all the clarity and understanding. So the new framework, right, under the Nigerian Tax Act 2025 has changed the rules. It has changed the rules, and misunderstanding these changes can lead to higher tax liability. If you misunderstand it, tax liability, higher one. Expense disallowances. There will be expense, it will be disallowed. If you don't understand what expenses are allowed. Then NRS penalty, Nigerian Revenue Service, there will be penalty. Then failed tax audits. If they come for tax audits, which is their responsibility, the audit, there will be failure of that tax audit because you are not complying. So you need to stay true with us on this live streaming as we break down this for clarity and we break it down in a practical way. So in section number 1, the new deduction rule. The new deduction rule. So under the 2025 Tax Act, an expense is deductible only if it is wholly and exclusively incurred in generating taxable income. So that expenses, to reduce your tax liability, it will only be allowed if it is wholly and exclusively incurred to generate taxable income in your business. So you need to notice something important here. The old rule says that reasonably and necessary. In the old tax law, we used to have it as wholly, reasonably, exclusively and necessary. But in this new tax rule, it is wholly and exclusively. So that reasonably and necessarily has changed. So this means that even if an expenses looks reasonable, even if it feels necessary, if it is not directly and exclusively connected to income generation, it can be disallowed. It can be disallowed. So you need to get it correctly. So this is a stricter compliance environment under the supervision of the Nigerian Revenue Service. So please, we want you to have this clarity. Section number 2, allowable expenses. Which expenses are allowed for tax deduction before you get the tax that is due to be paid? So let's look at what you can still deduct when you incur expenses. Staff costs. Staff costs, number 1, we have salaries, we have wages, we have pension contributions, and then employees benefits. So as long as they relate to business operations, they are allowable expenses for tax deduction. Then number 2, business premises and utilities expenses. So business premises and utility, we have example like office rent, electricity, internet, water expenses, waste disposal in your business. If it's your business location, it qualifies 100% for tax deduction. But please hold on to this live streaming and get the full gist. Please subscribe to this YouTube channel, like this video. Then number 3, loan interest, not principal. Loan interest, interest on loan and not principal. Interest on business loans is allowable. Interest on loan for business is allowable. So if a business obtain loan from the bank and they will be paying interest on that loan, that interest is qualified for deduction, allowable deductions to reduce your tax liability. But repayment of loan principal is not deductible. The principal, the main amount that you borrow, is not deductible. For example, you borrow 10 million from the bank. The 10 million is the principal and the bank is charging you 10 of it, which is 1 million. So it is that 1 million that will qualify for tax deduction. For tax deduction, the interest on loan. So you need to get it correctly. Then number 4, repairs and maintenance. So servicing business equipment, machinery, vehicle used for operations is deductible. So far it is used for the business purpose, it is deductible expenses. Then we have number 5, capital allowances instead of depreciation. For those that are watching us that are accountants, we know depreciation. So depreciation of course is what you subject your non-current asset to for the period that you are going to use it to. So you charge it as an expense. But the tax authority don't allow depreciation, they only allow capital allowance. So it is that capital allowance that is given instead of depreciation that you are charging in your books. So all those non-current assets, right, we have what we call capital allowances instead of that depreciation that you have in your books. So those capital allowances are used for tax deduction. So under the new act, you cannot deduct depreciation. Even in the old act, you cannot deduct depreciation. Instead, you claim capital allowance on your vehicles, on your equipment, on your furnitures, on your plant and machinery. So many businesses still make this mistake, right, of thinking that it is depreciation. It is not depreciation, it is capital allowances that will be used for tax deduction. And then in the old act, under this capital allowance, we have, you know, initial allowance, and then we have annual allowance for capital allowance. But in this Nigerian Tax Reform Act, we don't have initial allowance again, because initial allowance is the allowance that is given on qualifying capital expenditure once in the lifetime of that asset. But in this new act, initial allowance have been scrapped, is no longer in existence. Is no longer in existence. So we only have annual allowance. And annual allowance is the allowance that you claim on an annual basis on the period that that asset will serve you, based on what you have already subject that non-current asset to. So we need to get it correctly. So now, number 6. Number 6, we have startup expenses. Startup expenses, they are allowed. So this new law recognizes certain pre-commencement expenses, certain pre-commencement expenses incurred before operations begin. Pre-commencement expenses that you incur in your business before operation begin, provided they are directly tied to income production. Provided they are directly tied to income production. So section number 3, we have disallowable expenses. Expenses that are not allowed for tax deduction even if you incur it. That's why we are always giving you all this practical information, so that you know what you are doing in your business. You are not just doing anything as it please you, but you do it based on law, based on will help you to reduce your tax liability legally, and you need to get that right. So disallowable expenses, these expenses are not allowed. So now this is where many businesses get into trouble with the tax authority. Number 1, personal expenses. If you incur personal expenses, if you run personal costs through your business account, they will be disallowed during audit. Personal expenses are not allowed. So we've said it over and over on this YouTube channel to all business owner, and any business owner we come into contact with, we've always tell them, don't be running personal expenses from your business account. Look at the level of your business. What can your business pay you? If it is 500,000, take that 500,000 once in a month, send it to your personal account as your salary for the month, and then be doing your personal During audit, it allowed. It will not be allowed. So the example is personal travel. If you incur personal travel, family expenses, owner's private rent, all these are personal expenses. They are disallowed. They are disallowed. Then number two, expenses out percent. So then we have capital expenditure, buying of buildings. You cannot deduct the full cost immediately. Land and building, they are capital expenditure. So capital will now apply instead of all these full on your it is allowances that will now apply. Then we have number three, taxes and penalties. Taxes and penalties. So company income tax, they are not allowable expenses for the obligations. So they are disallowed. Penalties from tax authority, from regulatory authority, they are disallowed. Fines, they are disallowed expenses. So all these, tax and penalties and fines, they are disallowed. Number four, expenses without proper VAT compliance. Here we need to pause here and explain this very well. Expenses without proper VAT compliance. This is important under the 2024 reform. This is very important. If VAT was applicable but not properly charged, or if VAT was applicable, properly charged or remitted, the expenses may be disallowed. You incur expenses and you are supposed to pay VAT on it, but if you don't pay VAT on it, the expenses will not be allowed for tax deductions. So any expenses that you supposed to pay VAT on it, you must pay VAT on it so that it will be allowed for tax deductions. Please, business, entrepreneur, professionals, please get this clarity. It is important. Pay VAT on those expenses. For example, a professional, service firm, they are rendering professional service for you and they give you, and you're supposed to pay VAT on it. If you don't pay VAT on that professional fee, that professional fee will not be allowed for tax deductions. So you must pay VAT on it. And of course, if you pay VAT, VAT will be remitted. Withholding tax must be remitted. So anybody charging VAT that are qualified to charge VAT, they will charge VAT and then they remit. You too, you remit. Everybody remits. And it's a win-win for everyone. So any expenses that you incur, you're supposed to pay VAT on it. Please pay VAT so that those expenses will be allowed for tax purpose. But if you don't pay VAT on it, it will not be allowed for tax deductions. So this is a major compliance risk. It is a major compliance risk. And if you don't comply, then it will be an issue for you. Number five, non-arm's length related party charges. Non-arm's length related party charges, related party transactions, those that are related to the business, either family, either stakeholders, either partner, they are related parties. Those that are connected to the business, they are related party. So any non-arm's length related parties, they are not arm's length transactions. They are not transactions based on the market, right? What can be obtained in the market, they are just done by relationship and by association and all of that. It will not be allowed for tax purpose. So if your company pays inflated management fees to a related company, it can be adjusted or disallowed. If your company pays and they need to do something for you and you are inflating the management fee, the amount that you're supposed to pay, it will not be allowed, it will be disallowed, or it might be even be adjusted as well. So four, section number four, practical example. We'll be giving you practical example in this section number four. That your company made 100 million in revenue. Your company made 100 million in revenue. You claim 70 million in expenses. You say 70 million is an expense. But during review, during tax audit, during review, 15 million is disallowed. Out of that 70 million, 15 million has been disallowed based on all this that we have said for disallowable expenses. So your taxable profit increase because 15 million out of that 70 million have been normally from that 100 million, right? Minus 7 supposed to have 30. But because 15 has been disallowed, of course, no longer be 70 again, right? It will be reduced. It will be reduced. So that, that is the challenge for disallowable expenses from 70 to 15. From 70 to you only have 55. You only have 55 instead of that 70. But though million turnover, if you are not a professional service firm, you are considered as a small company and you be exempted from company income tax, development levies, from capital gain tax, provided your non-current asset, fixed asset is 250 million and below. So your tax liability will reduce once some expenses have been disallowed. That's how poor expense classification can cost you millions. Poor expense classifications can cost you millions. So in section number 5, common mistakes Nigerian businesses make. Common mistake Nigerian businesses make on these allowable and disallowable expenses. Mixing personal and business expenses together. See, this mixing and personal expenses together, in fact, is something that most businesses do. Most business owner entrepreneur, they do it very well, and this will cost them a whole lot in their business. We've ring bell, we've emphasized it, we are saying it every now and then on YouTube channel. Don't mix your personal and business expense transactions together. Pay yourself whatever the business can pay you. Send it to your personal account, do the personal transactions on your business. We've said it here. If you are connected to us on this YouTube channel and you are doing all of this, well, we will encourage you not to do it. Claiming full vehicle costs for mixed use. You are claiming full costs for mixed use. Vehicle that you are using for your personal self, you are claiming the cost, right? Full vehicle cost for mixed use. You are using it for your personal self, you are using it for a company, you are mixing everything up together. If it is for company, let it be. If it is for your personal use, let it be for your personal use. Deducting depreciation instead of capital allowances. The So depreciation instead of capital allowance, poor document. These are common mistakes. Ignoring VAT compliance, ignoring VAT compliance, paying related company inflated fees. Related company, you are paying them inflated fees. So under the 2025 reform, documentation is everything. You don't keep documentation and then there will be an issue. No documentation, there will be an issue. If you don't keep documentation, there will be an issue. So section number 6, how to stay compliant. How do you stay compliant? How do you stay compliant? It is very important you stay compliant. You must stay compliant. Compliance is very important in this. It is very important at this period that we are. You need to stay compliant. Compliance is everything. Compliance is everything now for you as a business. You must stay compliant. So at TOSJOHN Consulting, here is what we recommend. This is what we recommend for you. Maintain proper expense documentation. Separate personal and corporate bank accounts. Maintain non-current asset register. You need to maintain it. Review related party transactions. Very important. You need to review it. Then you need to conduct annual tax major transactions. You must ensure compliance. So as we close, if you found this video very useful and helpful, like this video, subscribe to TOSJOHN Consulting, share with other business owner, entrepreneurs and professionals. If your company needs help, tax compliance review, tax consultant, external auditor, please feel free to reach out to us for tax expense audits, for tax compliance review, capital allowance optimization, or 2025 tax reform advisory. We give advice on this tax reform. Send us a message today. Then the 2025 Nigerian tax reform is just a legal update. It is on. It is compliance shift. It is not just a legal update. It is a compliance shift. And the earlier you align your expense structure, the safer your business becomes. So thank you for joining us on this live streaming today. We'll see you in the next video. Thank you and bye for now.